Last week, I talked about building an AI power stock list using variable online sources. And we also cut that down to just the AI stocks that are optionable. Don't forget, we also rearranged those to see which ones were really moving the markets this year. Now, once you have this list in your hands, what do you do with these stocks? Especially if we're in the early innings of an AI breakout. In part two of this series, I want to show you 4 different ways that you can invest in AI, and they're not all buying stocks. Let's go. Hey folks, I'm Tom Gentile. Welcome to Tom's Trading Room. Let me first remind you of the stocks that we were talking about in last week's video. As you can see here, there's a list of 16 of these stocks. They start with Planeteer and run all the way down the list to Alphabet. And also I want to remind everyone, this is sourced by the stocks right now that are strongest in the AI sector. What I mean by that is that these stocks actually have performed really well. The higher on the list, the higher they are as far as year-to-date highs. Now, the top 5 you see are sitting on or just coming off of year-to-date highs. Now, full transparency, I already own 3 of these top 5 on this list. Wish I'd have bought more back when I did, but hey, enough of the pity party. Let's move forward. How do I invest in this list? So taking the top 5 stocks and using only those as examples for today, I could do the following. Number 1, I could just simply buy the stock. Take a look at this graph. This is Microsoft. Now, on the time that we pulled this, Microsoft was trading just around $346 a share. So buying 100 shares of Microsoft is going to cost you about $34,600. Now, something that I talk about and others across various financial channels is what's called dollar cost averaging. That basically means you commit the same dollar amount into several different stocks that you want to own for the long term. And maybe you recommit dollar amounts at different times. Maybe that's during the quarter, maybe that's every year. So for instance, if you put $1,000 into each position, that means that you'd have less than 2 shares of Microsoft and about 60 shares of Planeteer. Now, if we were looking at a minimum of 100 shares on the most expensive stock, then, Microsoft, we're talking about $34,600 for the position. Imagine if you were to dollar cost average that number. Now we're talking about $150,000 for the top 5 positions. It can get pricey at times. There are alternatives. So I'm going to be using Microsoft for the rest of this session, and you can do this on any stock that's in that top 16 list that I've shown you. First, let's talk about leaps. What are leaps? Leaps are, the definition of a leap is a long-term equity anticipation security, LEAPS. These are publicly traded options, and they have contracts with expiration dates that are longer than a year, but I actually look at a leap as an option that has greater than 9 months to expiration. Now, leaps have their advantages. There are cost and risk versus owning stock. And also because they have such a long time frame to expiration, you really do have time on your side with this one. But how much is this time going to cost you? Take a look at this. Instead of the stock, if we were to buy a December 19th, 2025 350 call, that's going to cost us about $71 or $7,100 per contract. Now, that's considerably less than owning stock, but it represents about 20% of the stock's cost. And what that means is that by buying this option, you're going to need the stock to be 20% higher than it is right now by the end of 2025 just to break even. Now, with stocks averaging about 10% a year, the option traders have already got this priced into the move. That means in order to double your money, Microsoft's going to need to go up 40% between now and December 2025. What else could we do? How about covered calls? Now, a covered call consists of selling call options against stock that either you already own or stock you intend on purchasing. In this case, if we sold the Microsoft December 350 call option against the stock to create a covered call position, here's what it's going to look like. Of course, we're buying 100 shares of Microsoft at $346 a share. That's $34,600. Then we sell a Microsoft December 2025 350 call. Remember that same 350 call? What if we sold it for $71? We take in $7,100. The difference of these two positions creates the covered call, a net cost of $275 or $27,500. What you're getting is a stock with about an 80% discount this way because the premium you're bringing in helps go against the cost of the stock itself. This also gives you a 25% potential return, even if the stock goes nowhere in the next 2 years. And you also receive any dividend that is paid out during that same time frame. So not bad for doing just one extra simple thing. But is there a way to create a position that could double your money over the next 2 years with only a small move in price? Enter the Leap call spread. Now, a Leap's call spread is no different than any regular spread. And in case you forgot, a call spread is buying a lower strike call and selling a higher strike call using the same month and same expiration date, just different strikes. Call spreads are an effort to reduce cost and risk while creating a realistically better break even than simply buying a call option on its own. Using our Microsoft example, here's what it looks like. We would look at buying the Microsoft December 2025 350 calls. Again, they cost 71 points, but we could sell the December 2025 400 calls and take in $48 per contract there. That gives us a net cost of $23, or the entire position would end up costing $2,300. Now, we have quickly discussed 4 different investing strategies using Microsoft. I say investing strategies because we're looking at this long term, looking out past a year. And according to the IRS, at least in my book, an investment is something that is greater than 1 year. Now, let's compare these across 3 different categories. We're going to look at cost and risk, we're going to look at break even, and we're going to look at, of course, reward. Considering the cost and risks, if we look at buying 100 shares of Microsoft at $346, that's going to cost us $34,600. The covered call, meaning buying the shares of Microsoft and selling the December 350 calls at $71, reduces our cost to $27,900. If we bought a contract in Microsoft, that 350 call at 71, again, that gives us the right to buy Microsoft at $350 a share. That's only going to cost us $7,100. But the spread, buying the December 2025 350 calls and selling the December 2025 400 calls, gives us a combined cost of $23 or an actual cost of $2,300. So looking at this, we can see that the cheapest cost across here is going to be the spread. Now, consider the break even. If we go out all the way to December 2025, our Microsoft stock break even is going to be exactly where we bought it at $346. The covered call has a reduced break even of $279. The 350 call is going to be $421. Remember, you take the cost of the call and you add it to the strike price to get your break even. Now, the same thing goes with the spread, but we're going to take the cost of the spread and add it to the lower strike. So with the 350 400 call spread, we're looking at a break even of $373. Finally, let's consider the return on investment if Microsoft gains just 20% by December 2025. The stock would be up 20%. Obviously, the covered call would be up 25% because of the reduced risk and cost on the trade. The 350 call would break even because, once again, by December 2025, if we're putting $71 into this trade, we needed to go up 20% just to break even. But the Microsoft December 25 350 400 spread, well, that could possibly be up 100% by December 2025. Which do you think is best? Leave your comments below. Here's my takeaway. Each strategy is going to have its own positives and negatives. Now, with stock comes no expiration dates. With options, one can increase our probabilities and decrease our cost and risks, or possibly even both. Using these strategies makes the most sense across a number of AI stocks, not just one, and stocks you feel comfortable with, and that helps diversify your risk even further. Whatever you intend on doing, I hope this helps you understand different options and different strategies when it comes to this new breakout industry. And by the way, all these articles and videos I wrote myself. No help from Chat GPT. I'll see you next week.